What's up, guys? Welcome back to Investing with Kai, and today we're going to be talking about investing in the monetary sense. So no matter what stage in life you are right now, whether you just graduated from high school or from college or you're a working veteran, I think these 6 tips will help you. Let's jump right into it. Tip Number 1, assess your debts. So the reason why I say assess your debts and not pay off your debts is because not all debt is bad. I know there are a lot of sources out there that make blanket statements about debt that are always pay off your debt. You should always pay off your debt first. Pay off your debt. But oftentimes, people don't think too much about the interest rates of their debt, when in actuality, some debt is good. So for example, if someone gave me a $100,000 loan at a 2% annual interest rate, I'd only be losing $2,000 a year. And I can take this $100,000 and go invest it in something like the S&P 500 index, which historically has returned 8 to 10%. So for every year that I don't pay back this $100,000 loan, I'd be losing $2,000 in interest while making $8,000 to $10,000. So I'd be profiting around $6,000 to $8,000 by not rushing to pay back this debt. This is a prime example of why not all debt is bad. I think we should always look at the interest rates and do the math on whether we're losing out on opportunity costs that we could do with that money instead. So if you have something like student loans or a mortgage at a 3 to 4% interest rate, investing those extra payments could actually put you further ahead in the long run because you'd be making 8 to 10% while only losing 3 to 4%. There's one more nuance. I think paying off debt is a huge stress relief, because you don't feel shackled to anyone else. You don't owe anything to anyone. And that's completely understandable. Again, which is why I say assess your debts and keep in mind both the mental health pros and cons of paying off debt, as well as the pros and cons of the opportunity costs depending on your interest rates. Advice number 2, track your expenses and budget. I group tracking your expenses and budgeting together because a lot of times people use these interchangeably, when in actuality, tracking expenses is essentially keeping count of your receipts, and budgeting is allocating your resources. A lot of times when people are just budgeting, they budget say $600 a month to eating out, and then they go over it and they go over $650. That's not budgeting, that's tracking your expenses. The reason why it's not budgeting is because budgeting would be I allocated $600 to eating out, and I spent $650. You spent more resources than you had. And budgeting is supposed to prevent that by giving you a realistic count of what resources you have to spend. I think it's important to track your expenses first before budgeting, because it's hard to allocate resources to something that you don't know the consumption of. So a good example of keeping track of your expenses is to keep count of how much money you're spending on necessities such as rent or utilities, and then how much money you're spending on discretionary such as eating out with your friends or buying that new pair of sneakers even though you just bought one last week. If you haven't heard of it before, I think Mint's a great resource for you to start tracking your expenses. It lets you connect your bank accounts and credit cards and then aggregates all of your transactions and even categorizes most of them for you. And then when you have a good sense of what your expenses are, it's now time to budget, which is allocating resources, your money, to these spendings. And you might realize that you're spending more resources than you have, which creates credit card debt. If I kept talking about the details of tracking your expenses and budgeting, it'd take up this whole video. So I'm gonna stop there. So let me know down in the comments if you'd be interested in seeing a video like that. I can go over more detail about tracking your expenses and budgeting, and also talk about YNAB and Mint, the 2 resources I use the most for tracking my expenses and budgeting. Advice number 3, make financial goals. Plan out some of your long-term goals, because a lot of times when we budget and track our expenses, we don't account for them. We don't keep track of the true cost of some of our goals. And what I mean by true cost is, for example, if I wanted to buy a car in 5 years and the down payment was $5,000, that's an extra $100 a month that I didn't account for, that should have been in my budget if I wanted to save up for that $5,000. And this could also be applied on a smaller scale. A lot of times we don't even keep track of our annual subscriptions. So after we paid off something like $144 for an annual subscription, we forget about it until next year. So for 1 month, you just have this really large expense, when in actuality, you should have applied the true expense to each month and saved up $12 a month so that you don't get a surprise $144 once every year. So this is why I think making financial goals, whether it be something large like buying a house or buying a car, or something smaller like a subscription, is really important, because it allows you to budget a certain amount every month to that goal, rather than accidentally spending the money and then being surprised by something like an annual subscription, or not being able to afford a home when the time comes when you want to buy a home. Advice number 4, avoid retail therapy. And when I say that, I don't mean that it's a bad thing to spend money on things that you enjoy, because after all, what's the point in having money if you're unhappy because you're missing out on necessities? But I do say that because oftentimes I see us spending money because we're unhappy with something. And maybe we're bored and we just want to see something new and shiny in our lives. I just want us to reflect a little bit more before we spend money recklessly. Sometimes retail therapy even creates a vicious cycle, where maybe you're unhappy with your job during the weekdays and then you spend the money you earned at your job at the mall on the weekend to make yourself feel better, only to be more dependent on your job on Monday when you go back to work because you didn't save the money. Now imagine if you saved that money and bought yourself a little bit of financial wiggle room. This could have provided you an opportunity for you to maybe take a break from your job and make a career change. Again, I'm not saying that spending money on things that make you happy is bad. I just want us to reflect a little bit more on our spending habits so that we can invest in ourselves instead. Advice number 5. Open a high-yield savings account. A high-yield savings account is an account that tends to pay you a high interest rate. And at the time of the recording of this video, high is about 1.4 to 1.5%. But a lot of people don't know there are savings accounts out there that pay you more than 0.000000001%. But they exist. There are savings accounts out there that pay you $10 to $20 for every $1,000 you have saved with them. You can do your own research, but the two that I'm most familiar with are Ally Bank and Discover Bank. And at the time of this recording, they're respectively offering an annual rate of 1.5 and 1.4%. Disclaimer, I'm not sponsored by these banks or companies to tell you this information. I just happen to be a customer of Discover and I'm very fond of Ally because I have friends who use Ally. But there are many other high yield savings accounts that you can find. Now this one's a little self-explanatory because who wouldn't want to have an annual return of $10 to $20 for every $1,000 they have saved rather than a couple of cents? And last but not least, advice number 6. Credit cards are your frenemies. There are plenty of credit cards out there that offer you 2 to 4% cash back, or the equivalent in travel points, in a category that you would probably love to spend in. And who doesn't want to earn money for doing something you were going to do anyways? If I was going to go spend $50 at a restaurant and I had 2% cash back, who wouldn't take the dollar back? So if you haven't signed up for a credit card that gives you 2% cash back or the equivalent in redeemable points, you should definitely go do it. But I want to talk to you about the issue I have with credit cards. And I think it incentivizes people to spend more than they would have. And that's an issue. If you're paying an annual fee for a credit card that gives you travel rewards, but you don't naturally spend enough to make those travel rewards worth your annual fee, this might incentivize you to spend more. So while you may be going, oh my God, my credit card rewards paid for a free $300 plane ticket? If you just outright bought the $300 instead of spending the maybe couple of grand you needed to spend to get the reward, you would actually have more money saved in the long run. Advice number 7. But Kai, you said there was only 6 pieces of advice. Advice number 7 is smash that like button if you haven't already. Jokes aside, I really hope you did enjoy my video and that you took something out of these 6 pieces of advice. If you want to see more content around personal finance and how we can invest in ourselves, don't forget to press the subscribe button and hit that notification bell. Till next time.